Guys, is this data correct?
Yes, we checked it twice.
How is it possible?
Even we did not believe it the first time, so we rechecked all the numbers.
This is going to be an interesting video, guys, and it's going to shock a lot of people. Good job. A lot of smart investors use SIP plus lump sum strategy for better returns. They have an ongoing SIP in mutual funds, and when markets fall, they invest a lump sum amount. This way, they get to benefit from market corrections. Now, we saw this happen recently. On 4 June, markets fell close to 6% after the unexpected election results. On that day, many investors invested lump sum money to benefit from the correction. But does this strategy work? Well, we dug through data for an answer, and the results were surprising. Hello and welcome to ET Money's YouTube channel. Before we go any further, a quick reminder. You're watching this video on ET Money's English channel. हमारा एक हिंदी चैनल भी है जहां पे ये सारी वीडियोस आप हिंदी में देख सकते हैं. And if you are or know somebody who wants to understand the basics of finance in quick and easy way, we have a channel called 5-Minute Finance. The links of the channels are in the description. Alright, in this video we will look at 3 things. First, we will see which type of correction works better. Should you invest a lump sum when markets fall or when the valuations are low? Second, we will see what should be the ideal size of the correction. Should you invest when the markets correct by 5%, 10% or 15%? And finally, we will see what should be your investment horizon to get the most out of this strategy. There's a lot of interesting insights in this video, so I recommend you to watch this video till the end. Now, for an analysis like this, we need to consider multiple different scenarios and assume a few things. So let's start by discussing the assumptions we have made. The first assumption was the amount you can invest through lump sum. Now, most of us want to invest whenever the markets correct, but very few of us would be sitting on cash all the time. So here, we made a few assumptions. First, the maximum amount you can invest through a lump sum annually will equal your annual SIP amount. So, if you do a monthly SIP of 10,000, the maximum amount you can invest via lump sum during any year will be 1.2 lakh. The next assumption is about when you would make these lump sum investments. For this, we took 3 different scenarios. First, you invest 24,000 whenever the markets correct by 5% from its all-time high. Second, you invest 40,000 whenever the degree of market correction is more than 10%. And third, you invest 60,000 whenever the market corrects by 15% from its all-time high. Now, if we divide these investment amounts by the total lump sum, we will arrive at the number of investments you can make in a year. In our example, the total amount you have for a lump sum investment is 1.2 lakh. So, if you divide this by 24,000, you get 5. Now, this 5 is the number of investments you can make in a year when the market falls 5% from its all-time high. The last assumption is about how you invest these lump sum amounts. For this, we assume that you capitalize on the first opportunity that comes your way. Let's say you decide to invest 24,000 whenever the market corrects by 5%. Now, this 5% correction can happen at any point in time. So to simplify our analysis, we assume that you make only one monthly investment and do this whenever the first opportunity arises. For example, let's take the case of 2022. Here, the Nifty 50 TRI was down 5% from its all-time high in 11 out of 12 months. But as per our strategy, you could make investments in only 5 months. So here you would have invested in the first 5 months when the markets was down by 5%. Now, in real life, you can make the lump sum investment as and when you have cash available. But since we needed to have a process, we took the first 5 instances that happened in any year. Now we used these assumptions and ran them through the Nifty 50 TRI data. Now if some of you are confused by the above assumptions, don't worry. In the next section, when we look at investment scenarios, you will be able to understand them better. Alright, let's start with a scenario where you invest a lump sum on a 5% correction. Now we analyzed Nifty 50 data for the last 15 years and identified periods when it was down 5% from its all-time high. So we combined this with the normal SIP and the results were quite surprising. If a person only invested through SIPs, he would make 13.78% returns on his investments. But If the same person used the SIP plus lump sum strategy, the returns were 13.77%. So there is hardly any difference whether you did an SIP or used the SIP plus lump sum strategy. This was quite surprising because we intuitively thought buying on dips would increase your returns. But here, the returns remained the same. Now we wanted to understand why this happened. So we looked at 5 random dates when we made our lump sum investment. We looked at how each of these individual investors fared over the long term. Now in some cases, the returns from lump sum investments were below our overall return of 13%. So each time you buy on dip, it doesn't guarantee higher returns in the long term. Even though we invested during market corrections, the prices on some of those days were not low enough to pull up the SIP returns. And that's probably why returns from the SIP plus lump sum strategy were the same as regular SIP. Now, to overcome this, we decided to look at another scenario. Here, we increased our market correction to 10%. The assumption was if the buying price is low, it should help pull up the SIP returns. For this, we identified periods when the markets were trading 10% below its all-time high. And in those periods, we did a lump sum investment of 40,000. Now, because the investment amount was increased, the maximum number of investments you could make in a year was also reduced to 3. Finally, when we combined these lump sum investments with the normal SIPs, the returns were 13.98%. Now, this was also only 20 points higher than the normal SIP. So, investing at 10% market correction did not make a huge difference either. We then increased the size of corrections further and did the same exercise for a 15% correction. Now, because the size of the market correction increased, we decreased the number of investments in a year to 2 and increased the investments amount to 60,000 per investment. Unfortunately, here too, the difference in returns was not much. Normal 15-year SIP generated 13.78% returns, while SIP plus lump sum generated a return of 14.05%. So the data clearly showed that increasing the size of market corrections was not very helpful in increasing the returns. So we changed our approach again and ran the same analysis for a shorter time frame. We did the same analysis for a 10 and a 7-year SIP. Here we found SIP plus lump sum strategy did slightly better. For a 10-year period, the simple SIP generated a return of 14.86%. The returns improved to 15.10% when you invested at a 5% correction from the all-time high. The returns improved even further when we increased the size of the market correction. In case of a 10% market correction, the returns improved to 15.44%. And when we invested at a 15% correction, the returns improved to 15.51%. So clearly, reducing the investment period increased the impact our lump sum investment had on the overall returns. In the case of a 7-year SIP, the simple SIP generated a return of 16.37%. The returns improved to 16.96% whenever you made a lump sum investment at a 5% market correction. And the returns got even better in the case of 10 and 15% market corrections. The returns were 17.53% and 17.83% respectively. Now this was almost 150 basis points higher than what the normal SIP generated. So after looking at the data, we had 2 observations. First, the strategy works fantastically well for a shorter time frame. Second, in the shorter time period, the higher the degree of market correction, the higher the returns that this strategy generates. Okay, so till now we looked at the returns when lump sum investments were made based on a fall in the index. Next, let's see what happens to the returns if we use the same methodology but invest a lump sum based on valuations. But before we proceed, if you're still watching this video, then I'm sure you're finding the content insightful. We do a lot of research and create content that you can use to make informed financial decisions. So I recommend you subscribe to our channel and press the bell icon so you never miss a video from us. Okay, now let's see what happens to the returns when lump sum investments were made based on valuations instead of price correction. Alright, as the first step, we filtered out the periods when the market traded at valuations below its historical valuations. For this, we looked at the Nifty 50's P ratio and compared with its long-term median P ratio since 2009. Now, all the other variables such as investment amount, investment frequency, and the degree of correction remain the same. Now, we couldn't do this for a 15-year period as we didn't get accurate PE data for the long term. So, let's see how this strategy fared for a 10-year period. Here, the returns of a simple 10-year SIP was 14.86%. The returns improved to 15.54% when lump sum investments were made whenever the markets traded 5% below the median P. As we saw in case of price correction, the difference in returns improved even further when the size of the correction was increased. The returns were 15.61% for 10% valuation correction and 15.97% for a 15% valuation correction. In the case of a 15% valuation correction, the difference in returns was more than 100 basis points. Alright, let's now look at this 7-year time horizon. Here, the returns of a simple SIP was 16.37%. The returns improved even further to 17.93% and 18.70% respectively after a 10% and 15% valuation correction. So, in the case of a 15% valuation correction, the difference in returns was almost 250 basis points for 7 years. Now, if we compare the returns in the case of price correction and valuation correction, clearly investing a lump sum based on valuation correction did better. Alright, let's summarize our findings from the analysis. Now, there are two key takeaways. First, if your investment horizon is more than 10 years, then buying on dip strategy will do little to improve your overall SIP returns. So, your focus should be on maxing out your SIPs. Invest as much as you can through SIPs. If you get a bonus in any period, you can spread it out over a few months and don't wait for markets to correct. 2. If your time horizon is less than 10 years, you can use this strategy to improve your overall SIP returns. Making a lump sum investments based on a 10 to 15% price or valuation correction has historically improved your SIP returns by 100 to 250 basis points. The only drawback with this strategy is the effort that it requires. Now, to follow this strategy, you need to track the index regularly. But if you find that not possible, you should simply max out your SIPs. Sticking to simple SIPs will probably not cost you much. And with this, we have come to the end of the video. I hope you found the analysis insightful. And if you did, I would request that you like this video and do let us know in the comment section which strategy you will follow. I'll be back with another video soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.